Hi, I'm Karen Ward.
And I'm Hugh Gimber. Welcome to JP Morgan Asset Management's Markets Explained.
Your weekly briefing, where we cut through the noise and focus on what matters most for investors, setting you up for the week ahead. Welcome back. It's the 18th of May. Good to have you here, Hugh.
Good to be here.
Lots to discuss. We're going to give an update on the Iranian situation and how markets are definitely getting a little bit more jittery about this conflict, churning through the economic data, which is starting to give us a bit of a read of how the higher energy prices are affecting the global economy. And then, of course, we'll cover the UK political situation, which is impacting markets closer to home. So let's start off with Iran then, Hugh. It's definitely fair to say that markets are becoming a bit more jittery. I think many, including ourselves, have been thinking this conflict is going to de-escalate. It's not in the interests of either the US or Iran to have a prolonged conflict. But we've been saying that for some time. And we know as the weeks go on, the impact on the economy is going to be more keenly felt. And the markets are therefore, I think, starting to question that de-escalation scenario. We've got oil prices pushing up over the course of last week, and the most dramatic impact has been in the bond market. We've had quite a sell-off in bonds, so long-term interest rates pushing up quite significantly across the West, and then that starting to trouble parts of the equity market as well. So it does seem to be that, again, we're not seeing any news that there's this de-escalation, that there's an agreement over how the Strait of Hormuz is going to be opened. But perhaps it's the economic data that's focusing the mind, isn't it, Hugh? We knew it was going to push down on growth and up on inflation, and we're starting to see that come through.
Definitely. And I think when we look at last week's data in aggregate, the message was that inflation is clearly rising, but also that growth is holding up okay, which I think explains why interest rates have been moving higher. If we go through some of the details, the Consumer Price Index print, the CPI print, was the main one that we were watching. Headline inflation now in the US hitting 3.8% year over year. Core inflation up to 2.8% year over year. So clearly in those numbers, we had the impact of higher energy prices, higher airfares starting to be passed through to the US consumer. But I actually think to really understand the bond market moves, we need to look at some of the other data out that we had last week as well, which was the producer price indices, the import prices, showing you that the cost of manufacturing in the US was rising quite quickly. And then also retail sales, telling you that US consumers, supported by all of the tax rebates that they were receiving over the first quarter of this year, are simply spending through this shock so far. So I think it's that combination of still steady growth and inflation pushing higher with further increases to go, which explains why the central bank expectations have been moving. So when we met last week, Karen, this time last week, you only had a handful of basis points priced for interest rate increases by the end of this year. Now you've got close to 20 basis points priced. In other words, nearly an 80% chance that the Federal Reserve will be raising interest rates by the end of this year.
And let's just spend a moment, Hugh, thinking about the dilemma this poses for the central bank. I mean, energy shocks or cost shocks are the stuff of nightmares for central banks. They have no good options on the table. If headline inflation is pushing up, that might at face value suggest they should be raising interest rates. Many of them have a mandate. Certainly in Europe, the mandate is all about price stability and keeping inflation at target. So that would suggest they should be raising interest rates. However, the problem is that rising energy prices in itself squeezes disposable income. I'm sure many of you have been out there filling up your tank over the weekend, are feeling the impact of that, and perhaps choosing not to go out for dinner or spend elsewhere. So there's the chance that actually just rising energy prices in itself and headline inflation rising damages growth, damages the labour market, and actually raising interest rates on top of that could just worsen the effect. And you can see the central banks are just struggling with what to do, aren't they?
They are. And this is where the US consumer so far has simply been saying, this is going to cost me more, I'll keep spending. We saw that in the data with gas consumption, i.e. petrol or diesel consumption, up strongly in the first few months of this year. Gas prices in the US now up 60% year to date. So far, so good for consumers because they're simply spending their way through this shock. But as you say, this can't continue. And that's why when I look at the path of growth this year, it seems very difficult to envisage a scenario where prices keep rising and inflation keeps rising, and yet the consumer just indefinitely spends, because it's all very well today saying, well, I'll just draw down on that tax rebate to fuel the cost of filling up my car. But there will come a point later this year where that really does start to squeeze.
Yeah. So at the moment, I think our expectation is that the central banks, because of this difficult dilemma, are certainly going to exercise a very high degree of patience, that the Fed are going to be in no rush to think about raising interest rates. In fact, they'd have to be really pushed in terms of clarity of that inflation problem to be raising interest rates. Similar degree of patience here in the UK. Maybe the ECB, a little bit more quick to act if they do. But ultimately, as you say, we do need to see a resolution of this conflict, don't we?
And I think in that context, we should also just pause on the meeting that happened between Trump and President Xi last week, because to me, the headlines from that summit were positive sentiments all round, both sides saying nice things about the other, but really no material deal being struck. And I think that's probably reflective of the fact that neither the US nor China here are in a position where their economy is strong enough to risk going too hard at the other. We know the US government needs to bring gas prices down ahead of the midterm elections, and the data that we've had out from China this morning have highlighted just how fragile that consumer recovery in Beijing really looks.
Yeah, and I think that's a really critical point, because I've always felt that probably the most influential voice, certainly in terms of incentivizing Iran to de-escalate, is probably the Chinese voice, President Xi Jinping. Now, he doesn't tweet his thoughts, so it's harder to necessarily know what conversations are going on. But as you say, the swathe of data out of China this morning weren't good at all in terms of the domestic economy. And so perhaps conversations, even if they weren't clear in Beijing with President Trump last week, perhaps those telephone calls into Tehran might actually be forthcoming as the pressure mounts.
Definitely. Now, obviously, Karen, closer to home last week, it was certainly anything but dull. We have quite a lot of political uncertainty starting to pick up. Do you want to talk us through your thoughts on what's been going on here?
Yeah, absolutely. I mean, when we met last week, obviously we were digesting the local election, which was a very bad result for Labour. And there were questions as to whether the party would feel that Keir Starmer needed to be replaced. And we've certainly got some individuals on manoeuvres in order to be able to challenge Keir Starmer. So Wes Streeting has resigned from his position in the cabinet and, starting to state what a government under him would look like. He's really put forward two big arguments. One is about the UK's relationship with the EU, certainly wanting to closen the relationship, if not re-enter altogether, as well as coming down quite hard on the need to constrain benefits in the UK. So that's where he has really put forward what he is offering, different to the status quo. He's on the more centrist right side of the Labour Party. And then, of course, on the more left side of the party, although we haven't heard as much yet about exactly what would be the offering, Andy Burnham, the mayor of Manchester, has resigned from his position. Now, he does need to become an MP in order to challenge, and that in itself is a hurdle. He's going to run in the by-election for Makerfield, and as we saw from the local elections, Labour winning these by-elections isn't a shoo-in at all, so that needs to happen first. He's obviously very well loved in Manchester. Perhaps where the bond market gets anxious about Andy Burnham is he has this quote on record for saying governments shouldn't be in hock to the bond market. Now, bond investors get very nervous when they hear politicians say things like that. And then, of course, another name, Angela Rayner, also similarly on the more left of the party, has cleared her tax affairs, so looks like she would be able to run. I mean, in terms of timings of this, none of this is going to happen this week, is it? In fact, the Makerfield by-election is scheduled, possibly, it's not even firmed up, could be the 18th of June. So we've still got some weeks even before Andy Burnham being able to challenge. So this probably is going to rumble on through the course of the summer. And I suspect that leads to, many feeling a sense of frustration. There's big things happening in the world, and therefore us fighting amongst ourselves about who's going to run the country doesn't seem ideal. I think the one silver lining I would bring to the discussion is there are some big conversations we need to have here in the UK about just some of our deeper rooted problems. Is our relationship with the EU ideal? Should we change it? And ultimately, how big a welfare state do we want? And are we willing to pay the taxes for that? And I think at least airing this conversation, I find a positive.
Karen, I think we would like to know the answer to lots of these questions. I know our fixed income colleagues would too. But also Andrew Bailey and the Bank of England are going to be facing a series of meetings by the sounds of it over the coming months where they don't know about the direction of fiscal policy. How do you see this impacting the trajectory of rates in the UK, if at all?
Well, I mentioned the word before, patience, just because generally when you have a cost shock, whether it's going to be a long-lasting problem for inflation or whether because of growth weakening, it actually means it's a short-lived rise in inflation. I think this would just add to that uncertainty and that sense of patience. If this political uncertainty leads businesses to be more hesitant in investing and particularly in hiring, we know the labour market in the UK is weak, then I think that would, again, cause them to be hesitant. So it just gives me a firmer conviction they're going to be on hold, Hugh.
And I guess that's where this week's data in terms of the business surveys, the PMIs, might be informative as well, because we have flash PMIs for May. So one of the timeliest indicators of what businesses are doing and how they're feeling coming out on Thursday of this week. And I think to your point, Karen, there we're going to get input and output prices. So a guide on how businesses are feeling the squeeze in terms of higher costs, but also how confident they're feeling about passing on those higher costs to consumers, as well as employment intentions. And we spoke last week about needing to take all of this inflation data in the context of how the labour market is doing. I suspect it'll be those components that you're most interested in when we get that data in a few days' time.
Yeah, exactly. I think for the bond market in particular, almost what we want to see is that input prices we know are going to be the component really pushing up. Maybe that isn't necessarily coming out into output prices because they're sensing that demand is soggy. That's going to keep the bond market calm. In some ways, it's one of those weeks where good news on activity is probably going to be bad news for markets if the bond market starts to really worry about central banks having to hike rates. But that's not our central scenario for the week, so hopefully it is relatively calm. We have been working hard in the team. We've written up a few pieces, particularly we've added our voice to the discussion on whether a new leader really would have the ability to dramatically change policy here in the UK, adding a little bit of the fiscal facts to the conversation. I think it's really important to recognise exactly what our fiscal situation is. So you can go to jpmorgan.am/Karen or jpmorgan.am/Hugh, and that will take you to all of the content that we produce. And, we've also in the team this week, we produce not only the Guide to the Markets, our flagship publication, but the Guide to Alternatives also, as clients finding alternatives a more useful part of the portfolio, particularly in a world when inflation's rising. And our colleague Aaron Hussein is going to be doing a webcast on some of the things happening in the alternatives world this week. So again, you'll find details of that if you go to the website. So busy week ahead, Hugh, and look forward to regrouping next week. Quick thanks for those who have listened and given us a nice review. Please do share. We really appreciate you doing so. Have a good week, Hugh.
You too.
Have a good week out there.
This communication is educational in nature and not designed to be taken as advice or a recommendation to buy or sell any investment or interest thereto. It is based on assumptions in current market conditions and are subject to change. It should be noted that the value of investments and the income from them may fluctuate in accordance with market conditions, and investors may not get back the full amount invested. Past performance, yield, or forecasts are not a reliable indicator of current and future results. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.